Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. On today's show, I brought on a special guest, Jarid Beck. Jarid's the director and co-founder of Risk Management Advisors. He's a career specialist in the design, implementation, and management of alternative risk management strategies, including self-insured plans and captive insurance companies. Jarid, welcome to the show.
Marc, thanks for having me.
So when you talk to a business owner, there are a few things that they're always looking for. Obviously the one is more revenue. They also want to be more tax efficient, or how can they legally pay more taxes? But a lot of them also look at their overhead. And one of the biggest expenses that they have in overhead is insurance. And then, you hear gripes about premiums rising. I think a lot of them don't even know what's covered by insurance and what's not covered by insurance. There's so many different types of insurance that they probably don't even realize if they actually have enough coverage or covering the right things. Maybe start off with just a kind of basic overview of what captive insurance is.
Yeah, that's a great question. When we got into the space and started working with more business owners, what we found was, they knew how to get rate of return from their business. They knew how to, grow companies. So it wasn't so much about investment returns or things of that nature in the context of financial planning, but it was really more they were being attacked by the things that stripped that wealth away. So it was taxes and then overhead in the form of insurance cost. And that was when we did our research and stumbled upon or discovered captive insurance companies. And what a captive is at a basic level is an insurance company that a business sets up to insure their own risks. And a lot of people will at this point say, oh, you mean like self-insurance? And yes, it is self-insurance to some extent, but it's a formalized version of self-insurance where you actually go out, form a separate corporation, and then go and get it licensed by the Department of Insurance to issue the policies that your business needs to protect itself.
It's really like a full-on insurance company that they're creating for this purpose.
Correct. So you go to a domicile or a jurisdiction that has captive enabling laws, laws on their books that allow you to set these insurance companies up, and it's fully regulated. Now, it's different than, the insurance companies that we see on TV, Berkshire Hathaway, AIG, Pacific Life, et cetera. It's a separate department that regulates the traditional insurance companies. Captives have a different set of regulators, and it's a more lenient, user-friendly set of regulations and regulators that oversee the captive section, but it is, again, still a regulated business.
Can you set up a captive insurance company for all types of insurance? Because if you look at a business, they might have medical insurance, workers' comp, general liability, cybersecurity. There's a ton of different types of insurance. Can that captive company cover or blanket all those different areas?
You can. There's different rules and thresholds around, which type of, coverage would be feasible for somebody to put into a captive. But at base level, most types of business insurance, again, if they meet the other types of criteria, can be put into the cap. Where we stay away from, or where captive, laws in general typically, don't go into, are the, the more personal lines insurance, homeowners and, things of that nature. But, as it relates to business insurance, workers' comp, errors and omissions, professional liability, general liability, property insurance, cyber liability, directors and officers coverage, and then, of course, medical insurance, all of those coverages can be addressed by using a captive.
Or does it usually result in lower premiums, or is it having more control over the insurance, or a combination of that and maybe some other things? What are the main drivers you see of people doing this?
It's a combination, and it depends on the line of coverage and the motivating factor. And a common misconception is that it immediately results in lower premium cost. So quite often we'll get a call from a panicking or desperate property and casualty broker. Hey, my client is interested in looking at captives. We've got a tough renewal on this policy coming up. They're not actually interested in looking at a captive. What they're really just interested in is a better quote or a lower quote, for that particular policy. But what captives really do is, give you the ability over the long term to avoid those up and down roller coaster rides of the insurance market. So long term, you fund the insurance company, you fund the captive. And then when premiums go up or premiums go down, it doesn't matter. You keep it level or stable. And that's really, one of the main benefits. Other driving factors for setting up the captive are, lack of available coverage. The insurance market lags behind on so many risks and exposures that businesses face. Oftentimes, companies can't get coverage for the things that they need. We've got clients that they have well-funded, well-established captive insurance companies. Those captives can step in and provide the business units coverage for those risks.
Can we walk through an example? Let's say you're talking to a company, they hand you over a pile of their insurance policies. What's the next step after that? To evaluate whether a captive insurance company makes sense or not.
Yeah, and that's the first step is we do typically collect, copies of all their policies, maybe have a discussion with their broker or consultant and go through and see, hey, here's what's covered, but here's the list of things that are not covered. And then, of that list of things not covered, which ones are actually important or substantial or pose a risk to the business. And then you can, build a captive program around addressing those. So some really good or primary examples, if you think about property insurance, some of the basic exclusions of asbestos, mold, are just standard exclusions inside of property policies. And so captives can be utilized to address those exclusions. On the West Coast out here, most property policies have large deductibles for earthquake, or it might be excluded altogether. So, hey, you've got your property policy, that's great. But the true big risk that faces all California real estate holders is earthquake. And so we have a lot of captives set up to address, the earthquake exposure. On the East Coast, out by you guys, it's more water, hurricane, wind-driven rain. You have big deductibles or big exclusions on those type of policies, out east. So we have a lot of clients that utilize captives to address, those gaps or, deductibles in coverage. Another good example is here in California, if you think about employment practices liability. So, your sexual harassment, your, wage and hour type issues, individual employees can come in and have a disagreement with, an employer over how they were treated and seek restitution for that. Traditionally nationwide, that's on a one-to-one individual to company basis. In California, there's an interesting set of laws which allow that employee, if he partners up with a plaintiff's attorney and, they find one other person who is potentially aggrieved, they turn that into a class action lawsuit under the pretense that, hey, if this business did this to this employee, then they must have done it to everybody that's ever set foot in that company over the years. And then it turns into this class action lawsuit and balloons into this much, much larger claim. And this has been going on for a number of years out here. And the traditional insurance market, the policies just don't cover that. They're not priced. The carriers don't price them to cover that. And if they did, it would be very expensive. And they're also just not really interested in dipping their toes into those waters. So that's a good example of, something captives can address.
Mm-hmm. So then back to the business owner, if he's trying to analyze this, whether it makes sense to do it or not. And let's just kind of take an example and maybe see if I'm thinking about this correctly. If on his insurance policy, there's a line item, and let's just say he has $1 million of coverage for some cybersecurity incident. And he says, yes, I want to retain this coverage. What amount of money would he have to fund into the captive to basically still have that coverage?
So there's two different pathways. The one we've been discussing is, just stuff you can't get coverage for. And then so we're going to set up a policy and fund premium into the captive to cover just stuff that's excluded, existing risks in the business. The second pathway is looking at, the coverages you are paying for, let's say workers' compensation, for example. And, if you are paying that $1 million of premium, then what we would do is, go to underwriters, go out to the carriers, go out to the reinsurance markets and figure out, all right, how much risk does the captive have to take on for that business owner to get a reasonable credit or savings on his premium? In the example you gave, company might be paying $1 million in premium, but if they have the captive take the first $250,000 of any claim that would come down the road, maybe there's a reinsurer or an insurance company that would write anything up and above that for $400,000 or $500,000. So it's going out and doing that exercise of saying, all right, let's have the captive take on a certain amount of risk and then have the reinsurance company or excess companies step in up and above that to protect the owner from anything catastrophic.
Makes sense. When someone sets up a captive for the first time, is it a big outlay of money that they have to put in? Or are they leveraging and borrowing money that goes into that captive company? How do they initially fund it?
Yeah, good question. So there's two components to setting up the captive. One is, there are fees associated with setting it up. It'll vary based on the type of structure the company is setting up, but one-time setup is typically anywhere between $30,000 and $50,000 to get the whole thing up and running, licensed, et cetera. And it'll cost roughly that per year to keep it running, maybe more or less, depending on the type of structure. There's an old saying if in the business that, if you've seen one captive, you've seen one captive, meaning that, conceptually, it's a simple concept. We're setting up an insurance company for a business, but, everybody's situation is unique, and some people are, going to want to do different things, and we'll need different vendors or programs in place to have it run optimally. So, that can vary the cost structure a little bit, but, that gives you an idea for a typical set of fees would be. When the company sets up or the owners set up the insurance company, there's also a capital contribution or seed money, if you will. If you think about any of us starting a business, we've all got to put in, some money to turn the lights on and get the licenses and do that. And captives are no different. So depending on the type of structure, be a capital contribution of some amount where the owners will fund that seed money in there. And typically that's a one-time contribution, and then the premiums that get paid in fund everything else from there on out. But there is that upfront capital piece.
Those initial premiums, do you think they're kind of normal premiums that the company's used to, whether they're a little bit higher, a little bit lower, or the same, but it's not like there's an enormous capital infusion to cover some of these risks that the captive is taking on?
Correct. And that's part of the analysis. So we call it a feasibility study, where you are sitting down with the policies, then also the finances, budget, considerations, objectives of the business, and looking at it holistically and saying, all right, well, this, and this are feasible. And, this is what the capital outlay would be. This is what the premiums would be. And then there's a decision to, do it or not do it. And part of it, is based on budget, capital allocation, short and long-term objectives. But, the items that move forward, it's always very conservative within a client's budget.
Is medical insurance a common one that you see a captive taking on?
Medical insurance is the fastest growing type of captive that we have right now, at least over the last 5 to 10 years. And the reason for that is costs continue to go up each and every year, and the carriers that are out there, there's fewer and fewer. In some markets, there's as few as 3 or 4 carriers that you can get quotes from. The costs go up each and every year, and then they tell you less and less about why it costs what it costs. And then it's doubly insulting, because then most of these companies are publicly traded. And then you go to the markets and you see that, they had record earnings this quarter, right? And then so they're jacking up employers' premiums, while simultaneously, making money for their shareholders. Just over the years, there's a breaking point, because for employers with any significant number of employees, after the payroll line item, medical insurance is typically the next biggest one. So you've got a big spend on that P&L there for medical insurance. So you get a lot of interest in, hey, how can I get some relief on my medical insurance spend? Naturally, what everybody worries about when you get into the medical space is, saving money sounds good, but what if somebody gets cancer or, something like that, and, we have a bunch of large claims. And fortunately, on the medical side of things, there's a very robust reinsurance market or stop loss market, where any number of insurance companies will, come in and take risk up and above a certain amount to cap, what the company or the captive would be responsible for. Those combination of factors have really led to a big growth in that space. In fact, it used to be that captives and self-funding on the medical side was only for the biggest companies, 1,000 employees and above, publicly traded, Fortune 500s, et cetera. But I actually recently just read, just this last year, for middle market companies, 100 and above, the number finally flipped to where it's more than 50% of companies in that middle market space are now self-funded and using captives as opposed to buying shelf products.
Is that just with medical, or that's across all the different types of insurance?
That's the medical. Mm-hmm. So yeah, when we would talk to middle market companies about captives and self-funding for medical, they would say, I thought that was just for the big guys, big companies. it definitely used to be. But just with the captives and the
Right.
the number of carriers out there that'll help protect companies when they want to go and take risk, it's flipped, and so now more companies are self-funding than not.
On that topic, is there a certain size company, whether it's people or revenue or something, where when you do these analysis, moving over to a captive makes more sense if they are a certain size?
Yeah, there's different metrics. If you're looking at the group medical, typically say 100 employees and maybe $1 million in annual premium. You can do some stuff smaller than that, but to make it interesting, I think that's that's a good cutoff. Workers' compensation, some of the property and casualty lines, also we'll say $1 million, $1.5 million in total premium would be the cutoff for an individual line. That being said, there are some programs out there, nice programs where you can get some good savings, down in that 300 to 400,000 range. Even didn't even exist as few as 2 and 3 years ago, but stuff that's come online, really nice solutions for that company that's in that few $100,000 range on their spend. So that's been exciting. And then if you're looking at your exclusions or just gaps in coverage, we would typically be thinking about businesses 15 million in revenue and above, just because like we talked about, there are some costs associated with setting it up. So you do want to have that critical mass so that you're generating enough premium to go in there to offset those expenses and still get the benefits.
If I'm thinking about this from a business owner's perspective, what's needed to operate a captive? Because if I'm a business owner, I'm thinking, I have my business to run. I don't really want to be running an insurance company. How are these managed and how are these run?
Yeah, we actually did a poll of our clients and we said, hey, happy that you chose us, happy that you decided to move forward. What was the main reason you almost didn't do it? And by quite a wide margin, it was one, until I talked to you guys, it seemed complicated. And then the 1B to that was, it also seemed like it would just take too much time. The idea behind, what we are as a captive manager. So the job of the captive manager is to essentially quarterback and run the day-to-day operations of the captive so that the business owner gets all the benefits, meets all his objectives by setting one up, but that it ultimately doesn't distract from the day-to-day operations of what they do best and what made them successful in the first place. So I always tell people, you can dig in and invest, as much time as you want into it, or again, stand back more at a, board level or advisory, objective setting level, and then let the manager and folks run it. So ultimately, with some forethought, it doesn't have to, be distracting or take too much time at all.
Is there any difference between industry or fields that a company is in where you see that more common than others? Or is it just basically they want to look at how to run their insurance program better, whether it's additional coverage that they need, that they can't find? Do you find, and I know you mentioned sometimes it doesn't result in lower premiums. Does it ever? Do you see the premiums lower? Is that one of the reasons why people will do it?
That can be one of the reasons why people will do it. And if the premiums are lower in the first year, then that's fantastic. But the idea would be that over time, as the captive builds up profitability, it builds up surplus, then it can, instead of premiums going up, premiums can be again held stable or lowered over time, and not just by a carrier that would come in and offer a cheaper quote, but something that's sustainable because you've built up, again, a strong insurance company, over the long run, and then you can sustainably charge lower premiums back to the business. The industry will often dictate which lines of coverage make sense to put into the captive. So as you can imagine, let's say a manufacturing company or a staffing company with a lot of employees, okay, and then they're providing benefits for all these employees, then they're going to have bigger than average, group medical spends or workers' compensation insurance because of the large payroll. So naturally, when we're talking with those companies, that's the focus. We're doing a lot of work with cannabis companies these days, growing fast, very profitable, emerging insurance needs. And one of the policies they're having difficulty getting at an affordable rate is directors and officers coverage. So a lot of these cannabis companies, they're going out, they are getting private equity money. They've got boards of directors, boards and their officers want to be protected with, directors and officers insurance, but the carriers are uncertain on this marketplace. So they're charging really high premiums or not offering, coverage at all. So there's a big demand and a big need for that type of coverage in in that space. Certainly cyber, cyber liability. We all hear about the cyber attacks and ransomware, et cetera. That market is becoming more expensive, and carriers are desperate to keep up. They can't keep up with the technology. So, there's some combination of traditional market replacement and then, covering exclusions there in the cyber space. So if you have any businesses, hospital systems or, professional service firms that are storing large amounts of sensitive data, cyber's a touchy issue. So, again, it just sort of gets dictated by the type of business and what they're in.
When we were talking about medical insurance, you were talking about if there's some, whether someone came down with cancer or something which could be a high expense, there's potentially the opportunity to go out to the reinsurance market, and there might be a way to get stop loss coverage so that it kind of limits what the company's on the hook for. Do you see that across other areas of insurance? Because that's one of the things I think about. You think about the insurance industry, and one of the ways that they get it to work on scale is because of scale. And that, based on these huge number of policies that they have, they can do the actuarial analysis and come up and determine how much premiums they need to collect, not just for that particular company, but across all companies, and therefore, like you said, make their record profits. But how would a captive company kind of protect themselves in that same way? And I know you gave some of the sizes, and some of them are, I'm sure as the bigger company they probably can have a better control over it. But what about some of those middle companies in terms of just getting hit with the catastrophic loss?
Yeah. So just like on the medical side, when you go over to the other lines of coverage, there are excess policies or reinsurance programs that the captive or the employer can participate in to protect themselves against a catastrophic loss. Again, workers' compensation, for example, it might be common for a company to take the first $250,000 of any claim that would come down the road, but then they're going to have a policy up and above that to protect themselves, from that permanent disability where the carrier is paying out for years and years and years. Again, you would have that excess or reinsurance up and above that. And where that reinsurance or excess would step in is going to be dependent on size factors and availability, et cetera. But that's definitely a big part of the analysis or equation there. Same thing with general liability, professional liability coverages. You're going to fine tune and only take as much risk as makes sense, but then ultimately again, lay off that catastrophic coverage to another carrier. There's also, you were touching on a key fact, which is risk distribution. So you think about auto insurance as, if I get in an accident, State Farm doesn't go bust because you drove safe that day, right? And so they have, some accidents, some not. Captives can also participate in pools where they're, sharing a portion of the risk they've retained. So having an extra layer or extra element of reinsurance, even for the risk they do retain inside the captive. So that's a bit of a deep dive, maybe Captive 201, but there are ways, mechanisms, and methods for just laying off that risk and making sure that the client has the right amount.
In that example you're giving about workers' comp, you said, the company will cover the first $250,000 and then have some kind of policy above that. Does that mean that the captive insurance company has $250,000 sitting there in the event that a workers' comp claim comes? That's the amount that they determine that they want to cover? Or what is the dollar or the cash correlation to what the coverage is?
It's arrived at a couple different ways. So one is the captive will have its own actuaries and underwriters. Essentially, we have or the captive manager will have its own actuaries and underwriters that it brings in to rate up each of the policies. So that $250,000 will be quantified or calculated based on the employer's actual experience. And, it might be $250,000, might be less, maybe it's a little bit more, but it's based on their rates and their losses. The other item that's instructive or helpful is going, top down, where, let's say the original premium was $1 million, like you said. And then we move the client's retention from, 0 to 250 now. And then now the carrier comes down and says, all right, well, now we're only going to charge you $400,000 in premium because we're stepping in at the 250 level as opposed to the first dollar. Well, that's pretty instructive that risk, that $250,000 per claim, the appropriate funding for that is in that $600,000 range. And then so that can start as a benchmark or a ballast for building out the premium. So, again, a couple different ways to go, top down, bottom up, but it's calculated individually per risk.
What is the actual difference between self-insurance and self-insured and captives? Is there a distinction between the two of them, or are they, I guess, very similar in terms of how they're structured?
Yeah, so we discussed the, sort of the regulatory and the formal corporate governance difference between just self-insurance funds and setting up a captive. But there are some real financial benefits to using an insurance company. If I self-fund, and I say, hey, I'm going to set money aside for, a rainy day for, XYZ risk, I don't get a deduction for that. I don't get to expense that unless I actually have a loss. So I'm going to set this money aside out of my profits, but then, that's still flowing down. I'm still paying taxes on that. Even though I might have a loss down the road, I'm still paying taxes today. What the captive allows you to do, when properly structured, is pay that premium over to the captive, and then you're going to expense that just like you would all of your other, lines of insurance coverage. So you get to accelerate that tax deduction for the premiums that get paid into the captive. And then on the insurance company side, insurance companies get favorable tax treatment under the Internal Revenue Code 831A, where they get to take those premium dollars, put it into reserves to pay potential claims, and then that, reduces or, potentially eliminates the captive's tax liability. So it becomes a very financially efficient way to reserve for potential losses for a business. Frankly, it was why Congress put it on, put that code section, on the books in the first place, was to give businesses and small businesses the ability to, create these reserves for, things they couldn't get coverage for or couldn't get, effective pricing for.
How is the experience for the insured? So, maybe we look at medical insurance. That's another complaint that people have, is that it's just when you have to deal with medical insurance companies or just using medical insurance, it's just not a good experience, whether that's from technology being and from the stone ages of some of these insurance companies to the service that they receive. Is it any different when you're running a captive company?
It certainly can be. So one of the byproducts of recouping the carrier's underwriting profit on the medical is, at renewal, instead of raising copays and deductibles and, employee contributions, the amounts that the employees are responsible for, you can actually lower the copays and deductibles and create richer benefits. In fact, when we consult with people on the medical benefits, we recommend they do exactly that, sort of as a social contract, if you will. Is, you reap these benefits and these underwriting profits. Let's reinvest in the employees, vis-a-vis, lower contributions for them and better benefits. And then, so that right there naturally facilitates a better experience. And then, a byproduct of, self-funding and doing the captive on the medical is you have access to, all of the data where, you can say, okay, what services do we need to put in place to, again, enhance, not only the financial outcome, but also the experience, that the employees have on the front end. So it's definitely can be a component to exiting the traditional market.
Yeah, makes sense. Well, we're just about out of time. Jarid, I want to thank you for being on the show. You gave some great info on how a captive insurance program can help a business owner. How best can someone reach out to you, or if they want to find out more information about what you do and your company do?
Yeah, we'd recommend you go to our website, which is www.riskmgmtadvisors.com. It has all of our contact information and some great information on the items we discussed today.
Perfect. We'll link to that in the show notes. Thanks again, and thank you everyone for tuning in today.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.